Good morning. Good Monday morning, David Roach, Quantum Strategy. This is your mini podcast on macro, which may matter on a Monday and the days coming after. Three topics I want to talk to you about today. One is the US election. I think it is looking more and more likely that Trump will win. Kamala Harris now only controls 2 of the swing states. And Trump controls the other 5. Now, the statistical significance of these results is not great because they're all very small margins, but nevertheless, they're there. So the likelihood of a Trump administration is rising. And I think he will do what he said he will do. He will put on those tariffs on international trade, and there will be retaliations. And he will tear up the alliances, which are the cheapest and most efficient way of projecting US power in the world. Both of those have high economic costs. The tariffs will raise inflation and lower output in the United States, and they are a tax on the consumer. And of course, most importantly for markets, will be the fact that they will cause the Fed to reverse policy. As regards the international alliances, this will undermine, if not destroy, trust in the United States and set off an arms race worldwide, which is economically extremely expensive. As for the Ukrainians and the Europeans, they will be hit the hardest because Ukraine will be betrayed and Europe will have to step into the breach, starting from high levels of fiscal deficits, which will have to increase to fund defense, and also the inability to produce the arms at the moment that Ukraine requires. So this is really bad news, I believe, for a market cycle which is based on optimism about everything. We'll have to get used to macro becoming a real economic cost and working against interest rate reductions and profits. The second thing I want to deal with is Japan. The LDP and Komeito have had a historical defeat and lost their majority. So we're in for a long period of messy coalition building, which will result in a weak Japanese government, either led by LDP and some either explicit or tacit support from smaller parties, but it will be unstable and it will not be able to do any of the things that Japan needs to be done. The other option is that you get a government led by the Constitutional Democratic Party of Japan, which did very well in the elections, but not well enough to form a government on its own, another messy coalition. The result is that the markets will anticipate that the Bank of Japan will be leaned on and will show itself not to be as independent as some would like to think. So the idea of raising interest rates and normalizing monetary policy is out of the window, and the yen will be weak as a result. As a result of the yen weakness, investors will go back to the old mantra, whereby they buy Japanese equities when the yen goes down, which is why the yen went down this morning and Japanese equities went up. However, the same weak governments ultimately try to buy political power in future elections. So they go in for fiscal stimulus packages and handouts to Japanese households. That is why JGB yields are rising and JGB prices are falling, because they know that weak governance in Japan will result in bigger fiscal deficits and a yet more unsustainable level of debt. Turning now to the Middle East. We had the Israeli retaliatory strike. It was limited to military targets, and the markets are reflecting that. The oil price was down about 4% when I spoke, when you look at Brent. And things have, in a sense, returned to normal. Now, why is that? The reason is because there are no economic spillover effects from this attack, and it was a very deep attack and successful attack on Iranian military assets. It doesn't spill over into a disruption of oil supply from Iran. It doesn't spill over into because of an attack on Iran's nascent nuclear weapons industry or its supply chain. So, well and good. This is another example of the disconnect between macro events and market volatility. We had a big macro event, the rate itself, and we had no market volatility except for the oil price to fall. So that disconnect between macro and market volatility is preserved intact this morning and will continue. It will not continue for long, however. And the reason is because it is quite clear that Israel will not live with a nuclear Iran. And Iran is obviously developing its ability to produce nuclear weapons. The breakout in terms of being able to produce the fissile material to do so is probably months or quarters away. And it is highly likely that Iran will be able to package this in a weapon by the end of the year. Israel will not go there. Therefore, Israel will attack Iran in a way which seeks regime change by shutting down its oil industry and wiping out, so far as it is possible, its nuclear weapons facilities, nascent though they may be, within 12 months. Once that happens, then you have the spillover effects of desperate attacks by Iran on Israeli cities and closing the Straits of Hormuz, through which 40% of the world's oil supply flows. So the most trenchant forecast I can make for you is this. It is the disconnect between macro and geopolitical uncertainty and market volatility is set to end within the next 12 months, because the economic costs of a Trump or the economic costs of an all-out war in the Middle East will quickly make themselves felt on the economies of developed economies, and through that upon inflated values in markets. And as those inflated values in markets fall, the feedback loop goes straight back into confidence, consumer credit, investment climate, and affects the real economy again. That is my single biggest and most high conviction bet on the performance and the crisis facing markets within the next 12 months. It will bring with it a recession, maybe more, and certainly higher inflation due to tariffs and oil, and it will be a bear market. Thanks a lot for watching. Sorry for the bad news, but at least you have some good news to deal with in actual markets this morning.